Hey everyone, me Kevin here. Let's talk about Tesla earnings today and my expectations and plan for Tesla. So, Tesla beat earnings 6 out of the last 6 earnings, which is really great, or at least it sounds great, but the reality is when we look at the stock chart, it's really not that phenomenal. In fact, if we go here to January 2020, yeah, the stock went up after earnings, but that was the last time. We traded mostly sideways in the April 20 earnings. We traded sideways then down in the July 20 earnings. We traded sideways for about a month in the October earnings of 2020. Then we traded sideways and substantially down in the January 2021 earnings, traded down after the April 2021 earnings, and now, what are we going to do after earnings today? Well, geez, if the pattern says anything, probably sideways or down. And the options market is kind of over Tesla at the moment. Options volatility for Tesla has plummeted, which is really, really bad if you own call options like I do. Unfortunately, my Tesla calls are bleeding. They have eradicated my gains on other options that I have, like Google, Enphase, or Etsy, all of which have made me hundreds of thousands of dollars so far, but unfortunately, because of Tesla, I'm basically at a big fat zero. So thanks, Tesla, and the lack of options volatility. What I really need from Tesla is some more frickin' volatility. Can we get some more volatility up in here, okay? I need some more frantic up and down and franticness to make some money here. And this sideways trading, boring crap is kind of bothering me. It's boring and it's annoying. But anyway, here's the thing. We got to take our emotions out of this. Not that I'm emotional at all over this. Let's take our emotions out of this and look at some numbers. In quarter one, Tesla delivered 184,800 vehicles. That worked out to receiving about $9 billion of automotive revenue, which worked out to about $48,712 per vehicle. If we multiply 48,712 by 201,250 vehicles delivered in this quarter, we'd get to about 9.8 billion. Now, we did deliver 1,890 Model S's and X's, which means we're probably going to be able to bump this average to around 50,000 as an average selling price. That would get us just over $10 billion in revenue. The street right now is expecting Tesla to bring in $11.37 billion in revenue, which that extra $1.3 billion is entirely possible through energy revenues and service revenues. We'll probably meet or beat the earnings. I don't know how much we'll beat it by, and this is where I get a little bit concerned. See, right now, energy revenues and solar revenues, in my opinion, are being held down by supply chain constraints. Inverters are harder to make and come by, and these are delaying solar panel projects and solar install projects. That's not so good. Tesla's energy game is also big on the long game, and so it can take longer for us to actually expect the energy revenues to beat. Now, maybe Tesla installed a bunch of new mega packs, which would be a miracle, but that also implies that Tesla had enough, again, supply of not just chips, but also batteries to do so. We also don't have enough S's and X's being delivered in Q2 to really expect the average selling price of each vehicle to go up substantially. So the reality is, this is probably going to meet expectations and meet what the options market is implying. In other words, we'll get earnings today, we'll have milquetoast earnings, and it'll be boring, and our options will continue to bleed as options volatility continues to sink. This is really unfortunate, and it somewhat implies that the momentum for Tesla is gone, at least the volatility momentum. Now, I am a Tesla bull, but I realize sometimes patience is really what's needed for stocks, but it really sucks when you're in options. And that's one of the biggest downsides of options, is patience costs you a lot of money. Theta decay is a disaster, and it is very, very expensive. So here's what's on my mind. Today is the first time I've seriously considered selling call options against Tesla to take advantage of whatever kind of improved volatility we would have today. That way, if Tesla meets or goes down, I'm good. I locked in some tendies by selling some calls. And if there's a beat, hey, no worries. I hedged myself and I had a little bit less profit because I still have my calls. But when I woke up this morning and I looked at Tesla's volatility, it was milquetoast. Like, we got no improvement in volatility. So really, the best case scenario that could happen here with Tesla, and this is a very crucial point, is for Tesla to just magically come out with some kind of insane beat by maybe crushing margin way better than it ever has in the past, And all of a sudden, Wall Street is like, oh my gosh, they got their efficiency down so pat that they are making so much money. This changes all of our algorithms in the future. And all of a sudden, Tesla shoots like 10-15%. That's going to change the volatility measures. That's going to help bail people out of options who have call options. We need a big freaking beat. Now, we're not going to get it on average selling price, and I don't expect we're going to get it on energy. The only place, and you've heard me say it before on this channel, especially if you're a subscriber here, the only place, in my opinion, we could see it is in margin, which what's really interesting is Wall Street right now is expecting margin to come in. The Wall Street consensus is for it to come in at 26.03%, which is actually less than previously. In Q1, we had 26.5%. Take out the regulatory credits, you're at 22%. Now, I personally think we could easily get back to that 27.7% level from Q3 2020. And one of the reasons we saw such a big bump over here is because once we saw COVID expenses go away, then we started seeing margin bump up again, which is very good. We want to get back on that trend of seeing COVID expenses go away. We're spending less on the plexiglass and the filtration, on masks, on sick time, whatever, and we start seeing that margin go up in the direction it should be going up. If we actually extrapolated our 2019 and 2020 margin improvements, we should realistically be closer to 28% gross margin using the vehicle credits as well. And Elon Musk's goal is to get this to 30%, not including vehicle credits. If we get a massive margin beat in this quarter, it's going to, in my opinion, set Tesla up for a wonderful Q3, Q4. It's going to hopefully lead to a big move in the stock price. Maybe we'll see another 2 or 3 week rally on Tesla, and we'll finally be able to bail out of option contracts that we have purchased. And once we get to peak euphoria, then we can sell calls and take big frickin' tendies to the bank. But short of a big margin beat, I'm very worried that this earnings day is going to be milquetoast, and it's going to suck because it's just going to bleed our call options even more. So we'll see what happens. Fingers crossed on a big marginal improvement for Tesla. Honestly, right now, not holding my breath, but I've got my fingers crossed, and I really hope we beat. Folks, thank you so much for watching. We need not just a little beat, but we need a big beat on margin. Watch me live when I cover the Tesla earnings later. And folks, we'll see you in the next one. Bye.